Welcome to the Best Investment Writing, your gateway to the minds of the world's most respected investors. Join us as they unveil the insights gleaned from their tireless research, providing you with invaluable perspectives to enhance your own investment journey.
All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Hi, this is Tim Alcorn, and I'm the Head of Investment Risk, Analytics and Research at Baillie Gifford. Baillie Gifford is a global long-term active asset manager founded in Edinburgh, Scotland in 1908. Our aim is to deliver excellent returns for our clients by identifying and investing in promising transformational growth companies early on and backing them over 5 to 10 years or more, and in doing so, make a broad contribution to society. To learn more about us, you can find us at bailliegifford.com. I'm going to share with you today a piece titled Lessons from Bessembinder. This piece reflects on the key lessons we've taken so far in partnering with and supporting the research of Professor Hendrik Bessembinder. It focuses on the topic of asymmetry in long-term returns and the characteristics of those fantastic few that dominate long-term wealth creation in equities. Hendrik, or Hank Bessembinder, is a professor of competitive business at Arizona State University. His 2017 paper, Do Stocks Outperform Treasury Bills, revealed that the entire gain in the US stock market since 1926 was attributable to the best performing 3% of listed companies. The paper was the first to provide an academic basis for the long-established investor practice of running your winners. This practice is based on the power of asymmetry in investing, the belief that gains from successful investments can, over time, far outweigh losses from failures. The paper has been downloaded more than 32,000 times and cited in more than 41 further studies. In 2019, in research sponsored by Baillie Gifford entitled Do Global Stocks Outperform US Treasury Bills, Hendrik Bessembinder showed that the skewed nature of stock market returns was even more extreme internationally. About 61% of non-US stocks underperformed Treasury bills in the 1990 to 2018 period, and 1.3% of stocks contributed all of the net gain when compared to the performance of US Treasury bills. Following this discovery, the next step was to sift through vast volumes of company data over a much longer time frame to discover the common characteristics of those big winners. The professor's work looked at the wealth creation of companies over 10-year periods. As the data covers many decades, some companies were measured multiple times over their lifetimes. This research revealed surprising things about successful companies, insights that make these companies easier to spot and to hold over time. There are 3 key lessons that I'd like to summarize here: to focus on growth, to expect drawdowns, and to beware biases. So lesson 1 is to focus on growth. Investing in research and development while still achieving superior growth in returns, scale, and profitability is a key characteristic of winning companies. Firms succeed or fail for myriad reasons, but this appears to be a must-have. Professor Bessembinder's new research into successful firms stems from his discovery of how, over a longer time frame, very few companies have made a big difference. Between 1926 and 2019, there was a $47 trillion additional growth in wealth of shareholders in US stocks, compared to the returns from US Treasury bills. However, this growth in wealth has been disproportionately generated by a small number of companies. Of a sample of more than 25,000 companies, fewer than 100 have created half of this wealth. This data only tells us so much, though. In our conversation with Professor Bessembinder, we've supported further research into understanding with what features of companies are represented in the long-term winners. The professor looked at 22 key fundamental metrics in his analysis and reviewed more than 26,000 10-year outcomes for US stocks going back to 1950. Of those 22 factors, only 4 stood out with significance, and those were strong cash accumulation, rapid asset growth, and in particular this is organic growth from increased output and product development rather than mergers and acquisitions, higher R&D spending, and finally, some evidence of larger drawdowns experienced for winners in the prior decade. This type of analysis of past performance can't help predict which firms will succeed in the future. Nevertheless, the research points out a clear correlation between possession of these measurable characteristics and long-term performance. By looking at firms' outcomes decade by decade, Professor Bessembinder provides patterns of evidence suggesting that over long-term horizons, returns follow fundamentals. This means that the firms that perform best are those that quickly grow their assets and accumulate cash, and profits are a key element here. Whether it's a high-returning young company or a wealth-generating mature company, spending more on research and development is key to profitability. Investors should deploy capital into the growth companies likeliest to generate capital returns. The professor's analysis makes these companies easier to spot. Lesson 2 is to expect drawdowns. Long-term investors in top-performing companies must have the stomach for large peak-to-trough share price declines. 2 examples highlighted in the paper were emblematic of this: Apple and Amazon. In the case of Apple, the company generated more than $1.6 trillion in shareholder wealth between 1981 and 2019. But during this time, the company has had its share of drawdowns and periods which would have been deeply uncomfortable for shareholders. Between May and August of 1983, for example, the shares in Apple fell more than 74% during the infighting that led to the ousting of Steve Jobs. Then, between 1992 and 1997, the shares fell 80% as the company faced stiff competition from PCs and the rise of Microsoft Windows. And, in the tech bust between 2000 and 2003, shares in Apple experienced a 79% drawdown. Equally, the example of Amazon highlights a company that created $865 billion in shareholder wealth between 1997 and 2019. But it too has had episodes of volatility and steep drawdowns, such as during the tech bust, when there were skepticisms following the post-tech bust relapse and the launch of Prime, and during the global financial crisis. These precipitous episodes can be deeply worrying and behaviorally fraught to navigate, both for companies and for shareholders. Bessembinder's research shows that this pattern is often repeated across a range of the largest wealth-creating companies. It's not news that even top-returning companies are prone to severe drawdowns. However, Professor Bessembinder's research reveals the severity and length of some of these periods of falling value. Investment managers must therefore tolerate occasional volatility in pursuit of big long-term gains. As share prices often reflect investors anticipating each other's next move, the share price of a listed company sometimes has a remote relationship with the business it represents. This suggests that investors shouldn't seek to just be different from the index, but to ignore it. The focus should instead be on the fundamental progress of a business. So, this brings us to the third lesson that we've taken from Hank Bessembinder's work: being aware of the biases associated with long-term winners. Looking at the breakdown of sectors within the research and the propensity of winners to have come from different sectors historically is quite revealing. Just because tech stocks have been some of the strongest performers, it doesn't follow that companies in that category have an outsized chance of extreme performance. Professor Bessembinder's research actually reveals the opposite to be true. It's easy to see how these shortcuts and mental shortcuts can be formed. 7 of the top 10 wealth-creating companies in the US between 1950 and 2019 are technology companies. However, technology companies are also underrepresented in the top 200 wealth-creating firms, whilst areas such as energy and communications have been more greatly represented. So, perceptions of industries can be misleading. Investors should beware the assumptions and mental shortcuts they use in describing top winners and what drives them. Industry definitions don't help, and they often oversimplify. Amazon, for example, is not just a tech company, but a tech-enabled retail company, amongst many other activities. What's needed is a careful study of individual firms and their competitors. The best approach is to build relations with founders and managers to help assess their chances of success. In concluding, it's fantastic to share these learnings with you. In the quest for winners, focus on growth, expect drawdowns, and beware your biases. Our work with Professor Bessembinder continues, and there's much more that we're excited to learn and to explore here at Baillie Gifford. Huge thanks to Hank Bessembinder for his fantastic research and our interactions. Thank you very much for listening, and thank you to the Meb Faber Show for the invitation to contribute to the podcast. Have a great day.
If you enjoy the show, be sure to leave us a rating and a review on your favorite platform. You can read investment research like you heard today by subscribing to the Idea Farm's free weekly e-newsletter at theideafarm.com. Thanks for listening, friends, and good investing.